Hey, welcome back, fellow value investors. In this video, I'm going to take a turn and cover bonds. I know that I normally cover stocks, which is really a majority of my time is spent managing my growth portfolio, my income portfolio of stocks that produce dividends, and I have a portfolio of bonds. And I'm building a bond ladder. And a bond ladder is basically a strategy to cover my living expenses for the next 5 years. I'd like to go over that and go over what I'm doing, why I'm doing it, and specifically why I'm doing it is that as I approach retirement age, I want to have a part of my portfolio that is going to cover my living expenses for the next 5 years while earning a good return. And that's what a bond ladder can do for me. So that's why I wanted to cover it. And I hope you find it interesting. Before I jump into reviewing my bond ladder, do me a favor and like the video, subscribe to the channel, and also please leave a comment. Let me know what you're doing with bonds if they're all at all interest to you. I know older investors like myself are interested in bonds because we like that low risk and defined return aspect of this investment, but I'd love to hear what you think. So the goals of my bond ladder is basically as I look at early retirement, I have a majority of my uh, investments are in real estate. I have rental properties. They've done really well. I get rents on those properties. And of course, there's appreciation over time. I have stocks, and I really find stock investing interesting. I love doing the analysis. I love getting, stock decisions that go right and over the long haul really reward me. I learn from stock mistakes that I've made, and everything's a learning process. So I love my stocks. But bonds are an important investment class that's becoming more important as I reach retirement age. And the reason for it is once I retire and I don't have steady income from my career, I need to have a very defined way of getting, the cash flow for my wife and I. And I'm building a ladder that's going to cover the next 5 years of redemptions and interest covering my living expenses, which is a good idea. Now, I'm a believer that it's good to practice something before you have to really do it. I'm not retired. I'm not planning to retire this year. And right now, I'm just really practicing. I'm going to be practicing managing a bond ladder. So when I do retire, I've got a couple years under my belt, being able to really manage this, track the performance, and be confident that this is going to cover our living expenses. So that's what I'm doing here. So the goal is to cover the next 5 years and really start practicing that. The other goal based on interest rates currently is to get a 5 to 7% return on this bond ladder. And the other goal is to really have a lower risk portfolio where bonds go up or down. In most cases, they go up or down very little. With the huge rise in interest rates that we saw over the last 2 years, you saw bond prices really drop. And that caused banks, as an example, to have a big problem because they were holding a lot of bonds, long-term bonds, and they lost a lot of value. I think that with regard to interest rates, we're not going to see that type of drastic move again for a while. That's my expectation. I think we're going to see a change in interest rates. They may go down a little bit next year, 2024. They may go down in 25. They may go up a little bit. And those changes in interest rates will cause bond prices to go up or down a little bit, but not a whole lot. It won't be like Meta, as an example. In 2022, it lost 80% of its value. This is Meta. This is Facebook. Generates cash like just at incredible levels. It lost upwards of 80% of its value in 2022. And now this year in 2023, it's a huge winner. It's almost up 200%. So that type of volatility, if you're a retired person, could really be a big problem because if you need to cover your living expenses, and let's say you were retired in the year 2022, you had a majority of your money tied up in Meta, it'd be a very difficult year because you're down so much. You may not necessarily want to sell because you still believe in the company. The stress on one would be really extreme. So you want to have a part of your portfolio where you don't really have exposed the next 5 years of living expenses to a high level of risk. And that's what a bond ladder is going to do for me. That's one of my goals. So how do bond ladders work? I have an illustration that I think does a pretty good job of illustrating how a bond ladder works. In essence, you have maturity dates on your bonds that will mature on a specified date, and you want to have bought enough bonds to cover your living expenses in year one. And in this example, it'd be $50,000. So you'd get bonds that mature and give you back the face value of that bond plus interest. And they mature at a level of $50,000 in this example. And you buy bonds that will do the same thing in year two. They will mature in year two and give you $50,000 back to live off of. Year three, year four, year five. Now, interest rates in that time will go up and down because it's just the nature of markets. They go up and down. So you'll need to adjust based on interest rates, maturities, and so forth. But you get the picture that you have bonds that are going to be maturing. Now, in my current position, I'm not retired yet. So I'm practicing. So I'll be able to take everything that matures and going to year two and just reinvesting it, putting it back into the hopper and saying, hey, I don't need the money yet, so I can just reinvest it. Perfect. And you just begin the process all over again. You're setting up your bond ladder to give you $50,000 to live off of for the next 5 years. And you just can continue to do that. And heck, if I retire and I don't need this cash flow, I just reinvest it. But it's good to know that, hey, if needed, I definitely have my living expenses covered. I can really be prescriptive about how many bonds I'm going to hold and how much cash flow I'm going to be getting from my bond ladder. So I think it's a very good model for me to follow. I can get my head around it. I understand it. And I think it's going to be a good tool for me to have a comfortable retirement where I have the kind of cash flow that I would like to have to live off of and have a little fun as well. My bond portfolio year to date is performing at 6.6%. And from a low risk part of my overall investments, that's a really good rate. I like it. And about 4% of this return is in the form of interest payments, which is really good to know. And then the balance, about 1.6%, is from appreciation of those bonds. Now, using the 10-year yield or 10-year treasury as an example, I wanted to show how interest rates really have been volatile. You've had this up, down of interest rates, up, down, and then we've had this really big rise in 23 and a really jagged drop. So volatility is my friend. If I use volatility to my advantage, I could buy investments at a discount. Let me show you what I've been doing with bonds to try to use this volatility in my favor. So with this volatility that we've seen in the market, when bond yields are going up and when the treasury yields are going up, you will see the price of a bond go down. So all along this particular move of interest rates, bonds continue to get less and less expensive. So buying, especially in this range, becomes an attractive proposition. You're basically given a higher return on your money as these interest rates go up. A bond that you bought in April is likely going to return 1 to 2% less than a bond you bought in October. So I've been buying bonds all through this range here, not trying to be perfect, trying to average in my buys on down days, but seeing that as interest rates rise, these bonds are being discounted more and more. And now that bonds are reacting to interest rates going down, as interest rates go down, the price of the bond goes up. So I haven't been as active as interest rates have been falling because my bond values have been going up, bond prices have been going up, and I don't buy when assets are when prices on assets are going up. And that's the same for stocks or bonds. So as I see the market changing based on the interest rate change, I have not been buying a whole lot of bonds. But you could see where volatility is a instrument to help me get a better return. And part of it is just observing the market and buying, especially on days when you see yields on the 10-year go up, yields on the 2-year, yields on the 3-year, and so forth. As that yield goes up, bond prices are being discounted. So I'm a buyer when interest rates go up, and I'm a holder when interest rates go down. I just see my bond values rise. So I'm sharing with you the bonds that I own and have put into this ladder format. Now, as I do in every video, I put out the disclaimer that I'm not recommending you buy any of these bonds. I never recommend any of the stocks that I covered. The goal of my video is really just to share my experience, and hopefully you find it interesting. Hopefully you learn something. And I've learned tremendous amounts of information from real life investors on YouTube. And I am doing the same thing for others. That's all I'm doing here is sharing my experience. I'm not making any recommendations for you to buy any investment I ever cover. Having said that, let me go over what I currently own and have put into my bond ladder. So this represents the investments that I have that really have a maturity less than really a month. And this stock, bond, as an example, is going to mature in less than 2 weeks. So that pretty much has a term of 0. And I also put my ETFs in here because I could sell those anytime. And so I put those in the term of 0. But things that are maturing within 1 year, and you can see that I have a bond that matures on January 15th, 2024, and all the way down to bonds that are maturing in November 2024. And these are companies. One of the benefits that I see is a lot of these companies I know because I've evaluated using, my stock analysis. So I know that AbbVie is a really good quality company. So I'm willing to buy into their bond knowing that AbbVie, based on my opinion, is going to be around for a long time. They're going to pay that bond, no problem. And it's all about risk reward. If AbbVie is a quality company, they're probably going to pay less interest than a higher risk company, let's say a General Motors. But I'm very comfortable with General Motors. I'm comfortable with every company that's listed here. I have a comfort level with them. And my particular bond investing approach is to be comfortable with the company that's issuing out the bond and then look for the best return based on the risk level that I'm taking. So these bonds are going to pay me in 2 things. They're going to mature and give me back my capital at the face value of the bond, and they're going to pay me interest. And in the first year, this covers my living expenses. So I'm building the model so that I get to practice for years and then get it right when I retire. And then year 2. So I've got, again, all these companies I own. I'm very comfortable with them. And these represent all my living expenses for year 2. Year 3, ditto. And what I realized was I have a pretty good gap in year 4. So I have a significant gap that I'm filling currently. Year 5 is in better shape. I think it's closer to my living expenses, but I'll need to really work on year 4. And I think that's why a bond ladder is a good idea. That way you're always really taking the next 5 years of your typical living expenses and you're taking that off the table, so to speak. You don't have to worry about that income. Now, since I'm not retired, all these investments are going to mature. They're going to give me back my capital, pay me my interest, and I'm going to take that and put it in a future year 5. So that's what I'm going to do with my bond ladder. Here's an example of what I'm doing. And again, my investment approach, my analysis of stocks help me in my analysis of bonds. And it helps me because I'm comfortable with a company that I've evaluated. I'm comfortable knowing that that's going to be a viable business for a long time. So I expect that company is going to pay their debt back, which is what a bond is debt. So this is my bond ladder as an example. Hopefully you find it interesting and you find this information useful in your situation. So I appreciate you watching the video on bond ladders. And as I summarize and conclude my video, I wanted to leave you with a couple of thoughts of who invests in bonds. Well, to begin with, ultra wealthy people, families invest in bonds. There's a term that you only have to get wealthy once. And what that term applies is that if you're a wealthy individual or a wealthy family, you don't necessarily put those assets into the stock market, because you could see like a down year, like 22, not too long ago. And you could see that, hey, I had a big net worth of $100 million, and all of a sudden, oh no, it's only $60 million now. And ultra wealthy people don't want that risk. So they put their money in bonds. They put them in something that is going to be a very defined return. The other investors that put significant amounts of money and capital into bonds are institutions, universities, governments that need to have that money for specific reasons over the next 5 years. And that is who invests in bonds. The bond market is much larger than the stock market. It's an easier investment for people to get their heads around, and there's more capital put into bonds. I think bonds are a very good investment for me to diversify into and have a part of my portfolio that is drastically less risk than stocks. So I hope you found the video interesting. I'd love to hear how you're looking at bonds, potentially how you're assembling a bond ladder, what you're doing to kind of think about where you can get income out of your investments. I appreciate you watching. Please like my video and subscribe to my channel. I'd really appreciate that. Thanks again for watching.